Good morning, viewers. Welcome to our Q2 Alts Dashboard. I'm Binette van Wyk, COO at Catalyst Fund Managers, and this morning I'm joined by Marcus Erlang, one of our hedge fund portfolio managers. Viewers, as you know, in one of our recent dashboards, we spent a lot of time doing a deep dive about our local listed property hedge fund. And this morning we shift our focus to our global listed property hedge fund, the Catalyst Alpha Global Real Estate Fund. Marcus, I'd love to hear from you about just a little bit more about the fund. Tell us about the history, the inception of the fund, and why you saw a need in the market to develop this fund at that point in time.
Yeah, so I think the Global Hedge Fund is an Irish domiciled USD denominated fund. We run it as a long short equity fund with a long bias, and it takes the structure of a qualified investor fund. And I think to understand why there was the need for the product, you have to look at the timeline of the Catalyst products and their rollout. So obviously the company started in 2001 with the first local long-only fund, and then it was followed in 2005 with the local hedge fund. Around 2007, 2008, the global long-only fund was launched. So it was the natural progression to then also have a complementary global hedge fund. So it was launched in 2015. So it's coming up to a 10-year track record. And the reason for its existence was just to generate the absolute best risk-adjusted returns within the listed real estate environment. The tools at its disposal obviously are to be able to go long, short, pair trade, exposure to the market. So I think it's just a very nice vehicle to be able to generate the best returns. And if you look at the universe, you have 300 plus stocks to be able to choose from. So the optionality allows for that selective investment and to generate those kinds of returns.
Marcus, if we touch on this fund and the return that you aim to deliver, what is that number that you are targeting, and how do you actually manage to get what you kind of promised?
So the fund has a benchmark of US SOFR plus 3%. At the moment, US SOFR is obviously quite high because of the higher interest rate environment. So that's around 7 or 8%. Through the cycle, we think that listed real estate should also provide a return of around 8 or 9%. In USD. So what the fund then aims to achieve is to be able to deliver excess returns over that benchmark. So the fund aims to deliver around 2 to 3% excess returns net of fees to that sort of 7, 8% through the cycle. And I think there's two things that the fund generally focuses on when it delivers those returns. The first one is a extremely strict adherence to the protection of capital. I think a hedge fund obviously is often in the news for generating outsized returns, this and that, but it needs to be done at a risk-adjusted level. So if you are able to protect capital in times of distress, then you don't have to capture all of the upside when the market recovers because you've managed to keep the base higher. So the fund does operate with sort of net exposure between 30% and 90%, depending on whether we see value in the sector. And it's important that in times of distress, the fund is positioned closer to the former, and then it can shift closer to the latter when there's a recovery cycle. And the second thing to note is that, as I mentioned before, you've got north of 300 opportunities in the FTSE EPRA Developed Rental Index, which is the underlying global listed real estate benchmark that we select the constituents from. So there is opportunity to go off benchmark and make outsized bets in stocks that possibly wouldn't be taken in a benchmark cognizant fund. As an example, in the listed universe, you've got 15, 16 different subsectors across multiple geographies. And a subsector like single family housing, for example, is a sector we really like. In the US, there's possibly 2 or 3 investable opportunities. It's very small in the benchmark, but it's one of the largest positions in the global hedge fund because we are not benchmark cognizant. And similarly, on the short or underweight side, a subsector like offices, which is a very traditional real estate subsector, it's 7, 8, 9% in the benchmark. The fund can choose to be net short or completely out of it because we don't like the subsector. So by combining the sort of the exposure through the cycle and being concentrated in subsectors without a benchmark cognizance, the fund is actually able to deliver excess returns to the underlying index and, like I mentioned earlier, at a far lower volatility, thus maximizing the Sharpe ratio.
Marcus, you alluded to this broad opportunity set that you have at any given point in time. But let's focus on how you are positioned right now. Maybe you can touch on that, and then just your broader outlook for the sector going forward.
So obviously, at the time of filming this video now, a lot has happened in the last few weeks in equity markets. And I think we've seen, since even the end of June, we've seen quite a wholesale change from, the market taking some profits in the tech sector and more value-orientated sectors getting a little bit of support, listed real estate being one of them. So in the last few weeks, obviously listed real estate has massively outperformed general equities or sort of the US tech kind of names. But being that as it may, it's come a lot on the firming of bond deals with a few good inflation prints and payroll prints, signaling to the market that possibly we're going imminently into the rate cutting cycle. So the listed real estate, our positioning within the fund is still above long-term norms. We still think there's good value in the sector, good pockets of opportunity, and considering we haven't actually even gone through the rate cutting cycle, the impact of that is still to come through the numbers. What we've had now is a rally based on sort of sentiment, but we still think there is good value in the sector, and as a result, we are positioned ahead of long-term norms. Another thing to remember is over the last 2 years, with funding costs being as high as they were and access to debt capital markets being so restricted, in a lot of subsectors within listed real estate, there's actually been very little new supply coming to market. And that is a big tailwind for listed real estate that I think is underappreciated, and you should see the benefit of that tailwind coming through in the next 2 to 3 years, or at least in the medium term.
It does feel like the tide is shifting a bit, hey, in our favor, finally.
Definitely.
Investors, for those of you based in South Africa, I think it is just a very key point to highlight to you that this offshore fund does have Section 65 approval. That just means that we are allowed to market this fund to you in South Africa. Marcus, I think you've got some viewers quite interested in the fund. So tell us, is this fund still open to new investment? Are you close to capping it? What's the timing of the dealing of the fund?
So at the moment, the fund is around $30 million, and the liquidity of the universe we invest in is exceptionally good. So we are open to new investment. When we started to actively market the fund, both in South Africa and in select markets offshore, one of the sort of the impediments to investment was the fact that the fund was monthly dealing. So in terms of allocation by allocators, there was appetite to do daily dealing. And after we did our due diligence, we realized that the size of the companies and the size of the fund was such that daily dealing would in no way inhibit investment returns. So earlier this year, we have actually moved to daily dealing, and we have seen increased appetite on the back of that. So in a nutshell, yes, open to new investment, and it is a daily dealing qualified investor fund.
Marcus, as always, thank you for your time and your insights. Viewers, thank you so much for listening in. If you'd like to learn more, please refer to the full Q2 dashboard, or alternatively, please reach out to me as per the contact details below. Thank you and goodbye.